Okay, we are recording. Hi there, everybody. I am doing this recorded lecture to go over the chapter 12 PowerPoints. Like we talked about in class, chapter 12, we are going over intangible assets and how we calculate amortization and impairment. And so, of course, like always, we're going to get practice with this in class together, but I wanted us to be able to go over the PowerPoints together and kind of get a head start on it. This is the last chapter that we cover in our book for Intermediate Accounting 1, and then we continue on in the textbook for Intermediate Accounting 2. So let me share my screen with you. Get it pulled up here. And so hopefully you're all seeing the PowerPoint now. I did put this PowerPoint in ALNet, so it is there. But we're going to be looking at, again, how we characterize or how we classify our intangible assets, whether they're definite life or indefinite life, how we account for these intangibles, patents, copyrights, trademarks, franchises, licensing fees, things like that, goodwill. If they are indefinite life assets, how we calculate impairment, how we record impairment, and then how these are presented on our financial statements. Okay, so intangible by definition means that it does not have physical substance. You think about things like desks or chairs or computers. We can touch those things. They have tangible, they're tangible in nature, right? They have tangible substance. Intangible assets, again, do not have physical substance. They're not financial instruments, but they are revenue producing assets, right? So some of these examples: patents, copyrights, franchises, licenses, trademarks or trade names, brand names, goodwill, things like that. I always like to use the example of an intangible asset like the Nike swoosh, right? Even though the swoosh, the trademark itself, doesn't necessarily have physical, it's not physical in nature, it's not tangible, it does earn revenue for Nike, right? Because some people buy those shoes just because they have that swoosh on them, right? So that's an example of an intangible asset. So in the valuation of intangible assets, we have to distinguish between purchased intangibles and internally created intangibles. So purchased intangibles, we would record at cost. Cost not only being the purchase price of the intangible, but any cost necessary to get it ready for us to use, similar to property, plant, and equipment, right? So the purchase price, legal fees, or other incidental expenses. Internally created intangibles, these are recorded at cost. Generally, we're expensing everything except for the direct cost, and that's what it shows here. We only capitalize the direct cost incurred in developing the intangibles, such as legal cost. And then it's given here the example that your book gives us of Google expensing its research and development cost incurred to develop its search engine, which is an intangible asset, of course. All right, amortization of intangibles. Again, this chapter divides it up into either limited life intangibles or unlimited life, finite life or infinite life, right? Or definite life or indefinite life, right? So limited life intangibles, we can reasonably estimate their useful life, AKA the number of periods that this intangible asset will generate revenues for us, generate cash flows for us. Generally speaking, we're going to be debiting amortization expense, crediting accumulated amortization. We should do this over the useful life. Again, the number of periods that will contribute to this asset will contribute to cash flows. Just like with property, plant, and equipment, we look at amortization. We calculate amortization based on cost less residual value or the value that it might have when we're done using it. We also call this salvage value, right? And then just like we're going to see with unlimited life or indefinite life, infinite life, right? Just like we're going to see with unlimited life intangibles, we should periodically test all of our intangibles at least once a year for impairment. Indefinite life intangibles, again, things like the Nike swoosh, for example, no foreseeable limit on the time the asset is expected to provide cash flows. We must test indefinite life intangibles for impairment at least annually. We do not amortize these. Again, because we cannot reasonably estimate the useful life in periods, right? Because this is an indefinite life intangible, we do not amortize. That's kind of a similar concept to like land. We don't depreciate land because we can't reasonably estimate how long the land will last us, type deal, right? Okay, so this illustration out of your book or chart, whatever, out of your book, is on page 614. And it just kind of shows us the difference in these limited life versus indefinite life intangibles. So limited life intangible, if we purchase it, we're going to capitalize the cost. If it's internally created, we're going to expense the costs. We amortize this over its useful life. And to test for impairment, we first test recoverability. What are the future value of the cash flows versus carrying value, and then also apply the fair value test. With indefinite life intangibles, again, if it's purchased, we capitalize. If it's internally created, we expense. We do not amortize indefinite life intangibles, but we test for impairment periodically. So 6 major categories. And again, the next few slides are going to walk us through each of these, but marketing related intangibles, things like trademarks, trade names, internet domain names, non-competition agreements, things like that. Customer related intangible assets include like customer lists, order or production logs, backlogs, contractual and non-contractual customer relationships, things like that. Artistic related are like copyrights, ownership rights to plays, literary works, musical works, pictures, photographs, and audio visual material. Contractually related, these are things like franchise licensing agreements, construction permits, broadcast rights, and service or supply contracts. Technology related intangible assets include innovations or technological advances, patented technology, or trade secrets granted by the U.S. Patent Office or Trademark Office. And then goodwill, and we're going to kind of go into goodwill a little bit more, but basically goodwill is the difference between, if we purchase a business, and let's say we purchase the business for $400,000, but the net assets of the business are only $300,000, then that's $100,000 of goodwill, right? So goodwill is essentially the excess or the difference between the cost of the purchase of the business over the fair value of identifiable net assets. All right, so again, marketing related intangible assets, things like trademarks, trade names, newspaper logos or mastheads, internet domain names, non-competition agreements. In the United States, trademarks have legal protection of 10-year periods, but then they can be indefinitely renewed. So essentially forever, right? So a company just has to renew these legal protections every 10 years. We capitalize the acquisition cost of this intangible asset, but because it has an indefinite life, we wouldn't amortize, we would test for impairment periodically. Customer related intangible assets, again, customer list, order, production backlogs, non-contractual or contractual customer relationships. We capitalize the acquisition cost, we amortize over its useful life. Here's an example of that. So this one says Green Market Inc. requires a customer list of a large newspaper for $6 million on January 1, 2017. Green Market expects to benefit from the information evenly over a 3-year period. Record the purchase of the customer list and the amortization of the customer list at the end of each year. So, again, the asset, when we purchase an asset, we're debiting the asset, in this case, customer list, crediting cash. And then if we're dividing this up over 3 years, then every year we're going to debit amortization expense, credit accumulated amortization, or as it's showing here, credit the asset directly. Artistic related intangible assets. Again, these usually have to do with copyrights or protections, ownership rights and protections afforded to artists for plays, literary works, musical works, pictures, photographs, video and audio visual material. The copyright is granted for the life of the creator plus 70 years. Capitalize cost of acquiring and, if necessary, defending, and amortize the expense over the useful life. Contract related intangibles, examples of these: franchise and licensing agreements, construction permits, broadcast rights, service or supply contracts. Again, if it has a limited life, it should be expensed over the life of the franchise. If it's an indefinite life, it should be recorded at cost, not amortized, but rather tested for impairment periodically. Technology related intangibles. Again, we talked about some of these: patented technology or trade secrets granted by the patent office or the trademark office. Patent gives the holder exclusive rights for 20 years. Capitalize the cost of purchasing a patent. We have to, though, expense any research and development cost in developing the patent. We amortize over the legal life, 20 years, or useful life, whichever is shorter. Here's our example of that. So this one says Harcott Company incurs $180,000 in legal cost on January 1st, 2017 to successfully defend a patent. The patent's useful life is 12 years, amortized on a straight line basis. Harcott records the legal fees and amortization at the end of 2017 as follows. So again, when we have to spend the $180 to defend the patent, we're going to capitalize that. So we're debiting patents, crediting cash. And then if we're dividing this $180,000 over 12 years, then we are going to amortize $15,000 a year. So debit amortization expense, credit accumulated amortization, or the patent account directly as shown here. Goodwill, as we mentioned, goodwill is an type of intangible asset, indefinite life intangible asset. And basically, goodwill is the difference between, like if we're purchasing a building, if we're purchasing a business, whatever the purchase price is, the difference between the purchase price and the value of the net assets, the fair market value of the net assets. And again, net assets, we usually think about this like equity, right? Net assets are our assets minus any liabilities. So here's an example of this difference, or determining this difference. So it says Tractor-Link Company decides to accept Multi-Diversified's offer of $400,000. What is the value of goodwill, if any? So if Tractor-Link Company has a fair value of net assets of $350,000 and Multi-Diversified is going to buy it for $400,000, that's $50,000 of goodwill that Multi-Diversified would record in this purchase, right? Here's another example. It says Global Corporation purchased the net assets of local company for $300,000 on December 31, 2017. The balance sheet of local company just prior to acquisition is, okay, so what we're looking at here is we're looking at the difference, this column, this cost column, right? That's our carrying value of the assets. And then we're looking at the fair market value. Oh, hot dog. the fair market value of the asset. So again, the fair market value is 225,000. But then we've got this debt of 25. So the net assets then are 200,000. And so if Global Corporation is purchasing this company for 300,000, net assets are 200,000. Again, they're going to record 100,000 of goodwill on this purchase. And so it's showing us that calculation here. Again, we're adding up our total assets, and then we're subtracting any debt, just accounts payable in this case. And that gives us the fair market value of the net assets versus the purchase price, and the difference is that goodwill. And so to record this, Global Corporation, again, is buying this business. So essentially purchasing all its asset and all its debt, right? So whatever assets are involved, we're debiting those assets, we're debiting cash, we're debiting receivables, we're debiting inventory, we're debiting equipment. And then we also owe, we're assuming this debt in the purchase as well. So we also owe 25,000. And then we're coming off cash of 300,000. That difference is the goodwill there, 100,000. All right, so impairment of limited life intangibles. Again, whether it's impairment of a limited life or impairment of an indefinite or unlimited life asset, we have to test our intangible assets for impairment periodically, generally speaking, at least once a year, right? And so just like it shows here, when testing these limited life intangibles, we first perform the recoverability test and then the fair value test. So number one, if the sum of the expected future net cash flows is less than the carrying amount of the asset, an impairment has occurred. Number two, the impairment loss is the amount by which the carrying amount of the asset exceeds the fair value of the asset. And again, loss on impairment is reported on the income statement under the other expenses and losses section. So here's our example of that. It says Lurch Inc. has a patent on how to extract oil from shale rock, right? This is fracking, right? We heard a lot about that recently, fracking. Unfortunately, several recent non-shale oil discoveries adversely affected the demand for shale oil technology. As a result, Lurch performs a recoverability test. It finds that the expected future net cash flows from this patent are 35 million. Lurch's patent has a carrying value of 60 million. Discounting the expected future net cash flows at its market rate of interest, Lurch determines the fair value of this patent to be 20 million. Okay, so expected future cash flows are 35. The carrying value is 60. So the asset is impaired 25 million, right? Now, the fair value is what we're going to compare to the carrying value in the fair value test. And so we see that here. On that fair value test, we're looking at the difference between the carrying amount of the patent and the fair value of the patent. And the difference here is that loss on impairment. The journal entry to record this, and we've seen a similar entry to this before when we talked about this in chapter 11, debiting loss on impairment, crediting the asset account. All right, so impairment of indefinite life intangibles. Again, with indefinite life intangibles, we test impairment through the fair value test. Fair value is the difference between the carrying amount of the asset. And so with fair value, it says if the fair value of the asset is less than the carrying amount, an impairment loss is recognized for the difference. So here's our example of that. In this example, we purchased this broadcast license for $2 million. And because of changes in the way the FCC handles these licenses, we have calculated that now the fair value of the license is 1.5 million. So we purchased the license. We had a carrying amount on the license of 2 million. Fair value now is only 1.5. So again, we've got that loss on impairment of 500,000 here. So this impairment summary, again, it shows us this in the book on page 625. Limited life assets, intangible assets. We perform the recoverability test, then the fair value test. Indefinite life, we perform the fair value test. And then goodwill, we perform the fair value test on the reporting unit, then the fair value test on the implied goodwill. And they show us this again on page 625 of your textbook. All right, as far as presentation is concerned, we've gotten practice with our classified balance sheet several times. We know that intangible assets are their own separate section on the balance sheet, the asset section. We have a section for current assets. We have a section for investments. We have a sections for, property, plant, and equipment. We have a section for intangible assets, right? So it would be a separate item or a separate section on the balance sheet. It is reported at carrying value, AKA book value of the asset, which means the original cost of the asset less any accumulated amortization or contra asset accounts. And then the final one here, companies should report as a separate item all intangible assets other than goodwill. Income statement, again, just like we do with depreciation expense, depletion expense, amortization expense should also be shown on the income statement, as well as any losses from impairment. And this illustration or picture out of your book, this is on page 627. It's basically just showing us that we're going to present, the presentation on the balance sheet are the net amounts, right? And then if we look at page 627, it also shows us how these notes look. Like, so how note C looks, how note D would look, right? But we're basically presenting the net amounts. But remember, behind these net amounts, like these intangible assets, for example, we know that we had some type of calculation for amortization behind there, right? So just kind of keep that in mind. Finally, this chapter talks about research and development cost. And just like it says in the chapter, we always expense research and development costs. Research and development costs can relate to research activities that are, planned searches or investigations aimed at discovery of new knowledge, or developmental activities, taking that new knowledge and putting it into a design for a new product or process, something like that. So new products, new processes, ideas, formulas, compositions, or literary works. And again, companies must expense all research and development costs when incurred. And this part, or this kind of chart out of your book, this is on page 628. Again, I mentioned a couple of these already. So research activities, planned search or critical investigation aimed at discovery of new knowledge. Examples include laboratory research, searching for applications of new research findings. And then developmental activities, translation of that research or knowledge into a new product design, a new product process, or a significant improvement to an existing product or process. Examples include conceptual formulation and design of possible product or process alternatives, construction of, construction of prototypes and operation of pilot plants. Accounting for research and development activities, again, we said that generally speaking, we expense the entire cost. So with materials, equipments, and facilities, expense the entire cost unless the items have alternative future uses. If there are alternative future uses, carry the items as inventory and allocate as consumed, or capitalize and depreciate as used. Personnel cost, we expense as incurred salaries, wages, and other related cost of personnel engaged in research and development. Purchased intangibles, recognize and measure at fair value. After initial recognition, account for in accordance with their nature, whether they're limited life or indefinite life. Again, limited life intangibles, we amortize. Indefinite life intangibles, we test for impairment. Contract services, expense the cost of services performed by others in connection with the research and development as incurred. And then finally, indirect cost, include a reasonable allocation of indirect cost to research and development costs, except for general and administrative expense costs, which must clearly be related to research and development in order to be included in research and development cost. All right, so this, again, illustration or partial income statement out of your book. I guess maybe condensed income statement would be a better term for it. This is just showing us that, in fact, the research and development expense can be a significant percentage of our total sales. If we were to take $7,180 divided by 42,237, again, that would tell us that research and development costs are about 17% of our sales. So of every $1 of revenue, 17 cents goes to research and development. So that's a pretty significant portion, right? All right, here are some of the exercises that we have picked out to go over in chapter 12 together. And I am going to stop sharing this screen. Hi there again. As always, once you have a chance to view this recorded lecture, if you have any questions, you know where to find me. Otherwise, we will get practice with it in class together. Bye, guys.